Hello, let's look at the transactions and events that came as a result of the review process on trade inventories. The items that we're looking at will be withdrawal of trade inventories by the owner for personal use, the recognition of inventory shortages, and the recognition of write-off of certain inventory items to the net realizable value. Let's look at this example. AC Entity's reporting date is 31st of December. AC Entity uses perpetual inventory system. The year-end review process in respect of accounts and records of the entity indicated that the following events still had to be recognized. What's important in this case is we need to start with the required to see what is required of us to do. Recognize the above-mentioned transactions and events in the General Journal of AC Entity for the reporting period ended 31st of December. And then the transaction will be like this. First transaction. On 31st of December 2007, the owner withdrew trade inventories with a cost of $28,000 for personal use. Trade inventories were delivered to the owner on the same day. This transaction still has to be recognized. The owner took some of entity's inventories for personal use, which will result in a drawing. The drawing will be recorded as debit drawings and credit trade inventories account. By debiting the drawings account, you are increasing the drawings to show that you've made more drawings during the reporting period. And crediting trade inventories, you need to show that some of your assets have decreased. So decreasing of an asset will be on the credit side. The perpetual inventory system indicates in respect of inventory item the quantity of items that should be on hand, as well as the average cost of each item. During the year, the physical units on hand are on simple basis compared with the number of units that are indicated in the system. The comparison will identify any shortage that arose. The shortage can be as a result of theft or because of items that are damaged. Let's look at the transaction. Says on 31st of December 2007, the inventory system indicated that the obsolete and damaged trade inventory items with a cost of $42,000 should be written off. The owner authorized the write-off. So, to record this transaction, you should recognize a loss that was suffered by the entity. Since this loss was suffered by the entity, that constitutes an expense. And then expenses increase on the debit side. So you are going to debit loss due to shortages and credit trade inventories because you have lost some inventories. At initial recognition, trade inventories purchased are measured at the historical cost price thereof. Subsequent measurement of trade inventories occur at the lower of cost and the net realizable value. The perpetual inventory system identifies inventory items of which the cost is more than the estimated selling price, which is your net realizable value. These items' cost has to be written down to the estimated selling price. The write-down are recognized in the reporting period in which the impairment of trade inventories occur. Now let's look at this transaction. On 31st of December 2007, the inventory system indicated that the certain inventory items cost is $38,000 more than the estimated selling price thereof. So now we will need to write down the cost to be the same as the net realizable value. So to do that, we will debit loss with write-down of inventories to the net realizable value and credit trade inventories. So the main thing that we do here is you always need to check which one is the lower between the net realizable value and the cost price. If the net realizable value is lower than the cost price, you need to decrease the cost price to be the same as the net realizable value. But if the net realizable value is more than the cost price, then you leave the cost as it is, because the rule says inventories are always recorded at the lower of cost and the net realizable value.